The US Federal Reserve announced its first interest rate cut of the year, lowering the benchmark federal funds rate by 0.25% point to a target range of 4% to 4.25%. This move approved in an 11 to 1 vote, so basically all the governors voted for it. And this marks a shift toward easing monetary policy after holding rates steady earlier in 2025, driven primarily by rising risk in the labor market rather than accelerating inflation. So they were actually the risk from the weakening labor market is outweighing the risk from inflation. That's why they decided to cut by a quarter point in today's meeting. Also, the decision aligns with the market expectations where futures pricing indicated a 96% chance of this exact 25 basis point reduction, though it drew a single dissent from the newly appointed governor, Stephen Myron, who favored even a more aggressive half-point cut, but we only got 25 basis points. The cut reflects the Fed's mandate of maximum employment and price stability, with recent data showing a gradual rise in unemployment and slower GDP growth. Also, inflation remains a factor with projections unchanged from June estimates. So basically back in June, and the Fed's projection for the inflation was sitting at 3% for 2025. This number did not change, it's a good sign. It shows that the Fed is not seeing risks from inflation this year. So they kept the number at the same level. Here, let's see, the FOMC's updated data plot of future rate expectations signals a more dovish stance. A majority of the officials now project 2 additional cuts before year end, potentially bringing the rate to around 3.6 by December. This is also a good number. So back in June, their projection for the federal funds rate was sitting at 3.9, which is higher than what we got today. We got a 3.6, which means we're going to get an additional rate cut in 2025. So all that shows that the Fed statement today was dovish. We'll see what happens in the next FOMC meetings, but that's for today. I'll see you in the next video.